If you run or invest in a real estate fund, you know the fundamental problem. You need property-level cash flows, fund-level consolidation, debt schedules with covenant monitoring, a valuation framework, and an LP-GP waterfall, all tied to the same portfolio. Most RE models have 2 or 3 of those, not all 5. This is what a proper real estate fund model looks like. Property level up through fund consolidation, through debt and valuation, out to the waterfall. Returns analysis on top. Let me walk you through it. Every tab is open. No locked cells, no proprietary add-ins. Your fund operations team can own it. LPs can audit it. Prospective investors can walk through any assumption. One dropdown runs base, upside, downside. I flip it. And every property cash flow, every NOI, every valuation, every waterfall tier updates in a second. Every assumption on one tab: acquisition prices, opex, vacancy, reletting, rental growth, exit cap rates, leverage terms, hold periods, fund fees. Property by property, parameterized separately. Because a Grade A office in the city isn't the same as a logistics warehouse in the northeast. Treating them with the same assumptions is how bad fund models over-promise. And the portfolio roll-up tab right next to it, so you can see holdings, acquisition dates, hold periods, and disposition timing in one view. The property cash flow engine. Every property, quarterly, across the fund's hold period. Gross rental income less vacancy and credit loss equals EGI. Minus opex equals NOI. Less TI and LC less capex reserves equals net cash flow from operations. Plus disposal proceeds at exit. Same structure for every property, which means you can compare them directly. Model reletting scenarios per asset, identify which properties are carrying the portfolio and which are holding it back. The debt side. Every loan, every property, every quarter. Opening balance, scheduled amortization, interest, drawdowns, repayments, closing. Covenant monitoring built in. LTV, DSCR, interest cover, calculated every quarter against the covenants you set. If any property trips a covenant, the dashboard flags it before your lender does. And valuation. Cap rate method for stabilized assets. DCF for value add. Residual for development. You see the mark-to-market of every holding at every quarter. Mark-to-market NAV falls out of that. Fund-level consolidation. Every property's distribution flows up. Net of fund-level debt, opex, management fees. The cash that actually becomes available to distribute. Then the waterfall. Return of capital first. Preferred return to LPs, the hurdle you've structured. GP catch-up. Carried interest split. Every tier, every quarter, cumulative through wind-down. This is the tab that determines what the GP actually earns versus what LPs receive. And it's the tab prospective investors spend the most time on. Returns analysis. Fund IRR, equity multiple, DPI, RVPI, TVPI. Every metric an LP will ask you about, sliced by vintage, by property, by disposition timing. Disposition analysis. When you sell each property, at what price to realize what net IRR, letting you rank and sequence the exits. And leverage analysis. Portfolio LTV trajectory, blended debt cost, exposure to rate risk. The Review Your Risk Committee does quarterly. Two-way sensitivity. Exit cap against hold period. Rental growth against vacancy. The questions the LP's IC asks you. Live. How much does fund IRR move if exit caps widen 100 basis points? The integrity layer. Property cash flows tie to fund consolidation. Debt service ties to debt schedules. Waterfall distributions tie to fund cash. NAV roll forward reconciles. If any fails, master cell goes red. Honestly, if you're running a fund out of a deck and a handful of spreadsheets that take a week to reconcile for every quarterly report, this is the replacement. One file, property level detail, fund level consolidation, audit ready waterfall. It's on sfsmodels.com under Real Estate Fund. Thanks for watching.